It starts with a shocking truth. In just a few months, nearly $19 trillion of household wealth vanished. Millions of jobs disappeared, and the global economy almost flatlined. But behind those numbers is a story that feels almost unbelievable. A story of a housing boom that grew so fast and so big that nobody thought it could ever collapse, until it did. Picture the early 2000s. Homes were selling faster than anyone could build them. Banks were handing out mortgages to people with spotless credit, shaky credit, or no credit at all. If you had a pulse, you had a loan. It felt like everyone was winning. But hidden under the excitement was a fuse waiting to burn. To understand how it all started, we have to go back to the year 2000. The dot-com bubble had just burst, and the economy was slowing down. To keep things moving, the Federal Reserve slashed interest rates. Borrowing got cheaper, and the push for wider home ownership grew stronger. The government pushed mortgage giants to expand lending to lower-income buyers. It sounded noble on the surface, but it poured gasoline on an already rising fire. Home ownership hit record highs. Lending standards hit record lows. Subprime mortgages exploded and ninja loans became common. No income, no job, no assets, no problem. It was like the entire country was playing a game with no rules. But the real danger wasn't just risky borrowers. It was the system that grew around them. Over time, a shadow banking world formed, full of investment banks and financial players operating without traditional oversight. They could take massive risks with borrowed money. And in 2004, regulations loosened even more. Investment banks were allowed to leverage themselves to staggering levels. The belief was that they could manage risk on their own. That belief was a fatal mistake. Banks didn't care if the loans were risky. They weren't keeping them. They bundled piles of mortgages into mortgage-backed securities and collateralized debt obligations. Credit rating agencies, paid by the banks creating these products, gave these bundles AAA ratings, even when many were built on loans that were barely holding together. Everyone was making money, and nobody wanted the music to stop. The logic was simple. Spread the risk and the danger disappears. The truth was the opposite. Spread enough garbage around and the smell just takes longer to notice. By 2005, the frenzy reached its peak. Nearly 20% of all new mortgages were subprime. Global investors couldn't get enough of anything tied to U.S. real estate. It felt like the money fountain would never shut off, but underneath, cracks had already formed. In 2006, an important warning light came on. The U.S. yield curve inverted, a sign that often predicts recession. Home prices peaked and then started slipping. Suddenly, borrowers who were already stretched thin couldn't pay their loans. Defaults surged. Those supposedly safe mortgage bundles, the ones sold and resold across the world, were now turning toxic. Banks, insurers, and pension funds holding billions in these assets were bleeding money. Subprime lenders collapsed. Bear Stearns hedge funds imploded. Panic spread like wildfire. By early 2008, a quarter of subprime mortgages had defaulted. Millions of homeowners owed more on their mortgages than their homes were worth. Then came March. Bear Stearns was on the edge of collapse and was sold off in a desperate rescue deal. It was a sign of how fragile the system had become. But the moment that changed everything came on September 15th, 2008. Lehman Brothers went bankrupt. One of the oldest, most respected names on Wall Street disappeared overnight. The next day, AIG, one of the largest insurance giants in the world, needed an $85 billion emergency loan to survive. Credit markets froze. Banks refused to lend. The entire financial world was on the brink. Congress scrambled to stabilize the system with a $700 billion bailout program. It wasn't just a rescue. It was an admission that the collapse could have taken down the entire economy. The damage spread everywhere. 4 million Americans lost their homes. Millions more fell behind on payments. Nearly 9 million workers lost their jobs. Global stock markets plunged. Trade shrank. Countries far from the United States felt the shockwaves. So what did this crisis teach us? First, deregulation without guardrails is dangerous. The financial system had too many loopholes and too few protections. Second, the watchdogs failed. Rating agencies rubber-stamped toxic assets with top-tier ratings. Third, the Federal Reserve kept interest rates too low for too long and trusted that banks would police themselves. And finally, we learned that complexity does not equal safety. When the housing market cracked, all those interconnected debt products toppled together. In the years that followed, the government stepped in with reforms. Interest rates were slashed to near zero. A massive stimulus bill aimed to revive the economy. New rules were created to prevent banks from gambling with money they couldn't afford to lose. The global banking system raised standards and tightened oversight. Recovery was slow. The Great Recession technically ended in 2009, but for everyday people, the pain lingered for years. Homes lost, savings wiped out, trust shattered. It took until the mid-2000s for many families to feel stable again. When we look back, the crisis wasn't caused by a few greedy bankers or a handful of risky borrowers. It was the entire system. A house of cards built on bad loans, flawed assumptions, and the belief that housing prices would always rise. People thought they had solved risk. In reality, they had buried it where no one was looking. So here's why this story still matters. Crises like this don't come out of nowhere. They grow from everyday decisions, overlooked warnings, and systems that feel safe until the day they aren't. And if you want to understand the economy, money, career growth, or even your own habits in a clearer, simpler way, there's a place built exactly for people like you. It's called The Average. It is a newsletter made for everyday people, the ones who weren't born into opportunity and don't have everything figured out. Inside, we break down money, business, AI, mindset, and productivity in a way that finally makes sense. No gurus, no jargon. Just real advice you can actually use to grow a little each day. If you want to level up without feeling overwhelmed or talked down to, you will feel right at home. The Average is where everyday people grow together. You can find the link in the description below. See you in the next video.